Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Okay, so good morning, good afternoon, good evening, wherever you may be, and welcome to the LiveSquawk preview show. If you haven't heard of LiveSquawk, we're a financial news service, audio news service that broadcasts 24 hours a day, Sunday through to Friday, and we aggregate all the important bits of financial market news and push it to our audience via our website. So check out livesquawk.com and see what we do and see if it's something you may find useful for your trading day. And these little shows that we do really to preview some of the key data that could affect markets throughout any trading month. It's a busy one today, and I'm joined by two guests to go through and preview some of the key numbers both today and tomorrow. Key events, numbers being the US inflation data due up at 13:30 GMT, 8:30 Eastern. And then a little while later, the Bank of Canada rate announcement. We'll also cover tomorrow's ECB announcement, interest rate decision, as well as the Swiss National Bank's quarterly announcement as well. And we'll also, if we have time, try and look at some of the implications really for central banks and for the Fed in particular from today's inflation report. So as I said, I've got two guys. Before I do that, do this disclaimer, just to make sure we do this bit. So just to note, content provided on this channel is for informational and educational purposes only. I'm not a financial advisor. None of the information shared, nor am I guess, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carry risks, and past performance is not indicative of future results. And with that little legalese bit out of the way, I'll introduce my guest then. I've got Michael Brown, senior analyst at Pepperstone, trading platform, brokerage platform. Welcome, Michael.
Good morning, good afternoon, whatever it is.
Well, we're in London, so we'll go with afternoon. And I've got Ryan Littlestone of Forex Analytics.
Morning, mate. Morning, boys.
Morning, afternoon. Welcome. Well, with newcomer Mike to the show. So welcome for your first showing.
Thank you very much, mate. Very good to be here, especially with my old mate Ryan as well. Yes,
I'm expecting a little bit of to and fro from these two guests. Right, let's start with the US data, and then we'll go through just the forecast here now, and then I'll give you a bit of bank research, and we'll go from there. So you got US November CPI read. This is the headline. CPI print expected to come in up 0.3% on the month versus 0.2% last. Year-over-year seen at 2.7 versus 2.6. As for the core measure, that's expected on the month up 0.3%, unchanged from previous. Year-on-year seen at 3.3%, also seen unchanged from last. A bit of research here from Citi. I noted that Fed officials have generally been highlighting that despite some bumps on the road, inflation is on path to get to 2%. They say softer November inflation data would further reinforce that narrative. After a few stronger months of 0.3% rounded increases, we expect core CPI inflation to slow modestly in November to 0.24%, with further slowing in shelter and more modest increases in categories like used car prices, airfares that were strong in October. And with that, guys, where do we, what would be my first question? How important do you think this is in the trading week, and what are you looking for from today's number? We'll start with we'll go with our new guest, Mike, for this.
Oh, thank you very much. My honest answer to that would be that, and I have a feeling that Mr. Littlestone is going to disagree, but I reckon this is probably the least important CPI print in about 3 years. Certainly options pricing would imply that. If you look at S&P options, they price a move of about 0.6% to the up or the downside. And really, when you consider, why do we care about CPI? We care about CPI because of how inflation could potentially influence the Fed's next decision. But actually, the Fed's reaction function is centered squarely on developments in the labour market at the moment. And with unemployment having risen to 4.2% in November, you'd argue that that pretty much nails on the idea of a 25 basis point cut at the December meeting. And actually, I think inflation is, I don't want to say it's a non-event, but really, I don't think that there is any print today that could materially shift the Fed's view of the December meeting.
Fair point. Ryan, are you going to disagree or agree with?
I'm glad you picked Michael first, putting age before beauty. But yeah, I'm gonna disagree a little bit.
Excellent.
Not in the importance. It's very important. This CPI number is really going to be the icing on the cake for the Fed next week. I've been looking at CPI. CPI has bounced. This will be the second bounce on the trot in the headline number. We got down to 2.4%, then it went 2.6, now it's expected 2.7. The core has been sitting in a 3.2, 3.5 range for months now. So that's why we've heard Fed members getting all anxious about the possibility of a resurgence in inflation. That's what's taken them away, talking about pauses at all.
Right.
I think for this number, purely on a trading basis, if we get a really hot one, if we get headline number coming in 2.8, 2.9, the core 3.5%. I think that really is going to push the market towards a pause next week. Does it mean they will pause? I don't know. I think it'll be a coin toss.
I was going to say that would justifiably you think that would be overegging it a little bit.
Yeah, that would really push them. It would really get them asking questions, and the market will move that way. Remember, that's all we're trading. We're trading the market expectations leading up to that. So, yeah, if it's a real hot one, it will push them towards that. Anything else, it's a 25 cut. If it's in line, if it's softer, it's a 25 cut. 50 is well off the table. So, yeah, the balance of risk is really playing the pendulum between a cut or a pause. And, really hot CPI, and the market will definitely push for a pause.
Mm. So again, I haven't got the market. I should probably get the market pricing up. I did have it on the likes of 25 basis point cut, but I think it's relatively high.
We're about 85% at the moment. Yeah.
So I mean, it's going to take a lot to push that pendulum really away from that level. But as we know, we're getting into the time of year, I guess, when traders get a little bit more fickle and the markets get a little bit thinner, and we see the more erratic sort of price moves around events and data points. Just digging quickly within the number itself, I think a bit of focus will be on the shelter costs, because they've been a persistent driver of the core price increases that have been seen over the last few numbers. And I think from looking at some of the analyst notes here, this is from Citi, they expect shelter inflation to continue trending downward in the coming months, albeit with more volatility than usual in these components. So I guess you're picking apart bits of the report, but as you said, in terms of the tradable side of things, we'd have to get a really wacky number to sort of see any persistent sort of moves as per.
Yeah, I think so.
Yeah, fair enough. Right, just while we'll stick on the US and last week's labour market report and Fed comments around this then. So we've got a Fed rate decision on the 18th. That's next Wednesday. Are you expecting, if we look a little bit into the future now and take this reading as roughly in line, as you say, unless there's some anomaly on it, and even then it's with far-fetched to see any kind of change in monetary policy or a perception from Fed officials. If you've read some of their words of late, and the likes of Waller and Daly and Powell himself, do you see them moving to a quarterly sort of cuts or just slowing that pace right down? Or do you think there's this underlying issue that they have with prices, and they think that, where do you think Fed officials are? Where's their heads at the moment, Mike?
Yeah, it's an interesting one, because if you'd asked me this question in September, I'd have said actually the Fed are in a real rush to get rates back to neutral. And of course, no one knows exactly where neutral is, but I think most sort of learned scholars are saying it's about 3%. So let's just take that as a sort of ballpark figure. But it's been really interesting how the rhetoric and the remarks from Fed speakers have changed since that 50 basis point cut, because we're now in a position where actually the labour market is still pretty tight. I mean, unemployment at 4.2% is not really anything to worry about too much. And inflation is, moving in the right direction, but it's in a relatively bumpy and probably slower fashion than the Fed would want. So they have started to build a little bit more optionality into their policy decisions going into 2025. And I think the other thing that policymakers are starting to consider is, what does the new administration bring? We've spent a lot of time recently talking about the potential for tariffs to be imposed on imports into the US. We're also talking about extending and potentially increasing tax cuts, and also just broadly a very reflationary fiscal policy stance. So actually inflation risks, or upside inflation risks, I should say, are pretty intense next year, and particularly in the back end of next year. So I think the Fed are going to start becoming a lot more cautious in 2025 than they have been this year. I mean, I guess the easiest way to describe it is, to use sort of Ryan's pendulum analogy from earlier on. This year, the question has been, they either stay relatively dovish or become more dovish. Well, actually, next year, that pendulum could swing a little bit more back to the hawkish side if unemployment continues to hover around this sort of low 4% mark, and those upside inflation risks do start to materialize. So I certainly don't think we're going to have a Fed that's cutting at every meeting next year. I think they are going to be much more data dependent. And just lastly, because no one knows where neutral is, we're on a journey, but we don't know where that destination is. And I think the Fed are going to become a lot more deliberate as they get closer to that 3% mark, because the last thing they're going to want to do is over loosen policy and risk inflation flaring up again,
especially with a Trump administration, I guess.
Absolutely.
Ryan?
Yeah, I'm along the same lines. It has struck me over the last few months that the change, particularly from Powell. I mean, his last comments a week or so ago, where he spoke about the economy doing really well, better than they forecast in September. Really sounding bullish and less dovish. And then we had that statement line removal about how they'd gained greater confidence in inflation coming down. It's all these little tweaks that I've heard from various members and some of the big ones as well. And yeah, it's making me feel a bit more less dovish. I won't use my undovish term because Michael doesn't like it.
Oh, please.
I'm just getting less dovish about them. And I think even if they do cut next week, it's probably going to come with more messaging to say that they're ready to go either way, but that a pause might be coming up if inflation continues the way it's going. Obviously, if we get a really soft number today, then I'm going to change my mind in 5 minutes. But that's markets at the moment. But yeah, I think that's which way the Fed are going to go. They're going to be very scared if inflation starts rising again properly, because they've done all this work in hiking rates to get inflation down. They haven't achieved target, and if it starts going up again, it becomes another credibility issue, and that's light years away from the ECB, where you've got the likes of Vilroy and others, doing victory laps that inflation's back at target, and they're waiting to get a bit on the bum as well for that.
Well,
that is a very different dynamic, though. Sorry to jump in, because you've got the Eurozone, where you've got inflation is at risk of undershooting the target, but that's not because of any global factors. That's just because demand in the Eurozone has been almost completely destroyed, whereas actually in the US, the demand side of things is bubbling along quite nicely.
Yeah, absolutely. Yeah, and that is the risk for the ECB, that they end up thinking they've got victory, and then it just keeps on going. So then they're chasing it the other side. But I know Harry wants to talk about that in a bit more.
We will do, and we will go on to that. I was going to read out just a little bit from Daily, not Daily, but Daily, as well as the Fed chair, Jerome Powell. So he, referring to what you're saying, Ryan, last week he said, some of his remarks included, the US economy is in very good shape and there's no real reason for that not to continue, and added that we can afford to be a little bit more cautious as we try and find neutral, which backs up both of your comments, really. And then we had San Francisco Fed Daily echo these sentiments, stressing there was no urgency to cut rates. and she noted that readiness to raise them if inflation were to if inflation were to resurge. So I guess they're just putting out those little flags out there and just making people aware that we're obviously not a turning point, but I think just we're putting the brakes on is not an unreasonable assumption for markets to take. Before we get on to the ECB, I just want to quickly look at Bank of Canada, because that rate decision's today at 14:45 GMT. And again, J. Morgan says following Friday's labour market report that argued that November's job figures supported another large Bank of Canada cut. It said sticky elevated wage growth had been another factor that seemed to point toward a more gradual pace of easing, but a larger than expected drop in wage growth in November also leans in favour of another outsized easing. In response, we now see BOC reducing its policy rate by 50 basis points to 3.25% at this week's meeting. We won't delve too deep into it. I mean, it's well along the path, the Bank of Canada, in terms of its easing cycle. It has other issues on the fiscal side. We've got a Trudeau government that's not particularly stable right now, and lots of moaning about immigration and, again, growth per capita on the weak side. So just briefly, do you see a 50 basis point cut, and do you think it's warranted, and will we see yet more down the line? Ryan, you can go first this time.
Oh, lovely. Thank you. I'm really on the fence with this one. The reasons for cutting 50 is as you've stated. The reason for slowing down, maybe going to a 25, is the fact that they've already cut 125 pips since the summer. Inflation has maybe started stalling as well there. We've seen it going up in the core measure for the last couple of months.
And wages.
And that jobs report, we saw a wonky one on the unemployment number with that participation rate as well. But we saw double the expected number of jobs gaining, and it was all going into full time. So that's a positive. So I think the market is looking for a 50. I think it's underpricing the prospect of a 25. But what they do, I'm really on the fence.
Okay, fair enough. Mike?
Yeah, I'd probably lean a little bit more convincingly towards them going 50 basis points this afternoon. I think the unemployment rate rising from, 6.5 to 6.8 in November is probably going to spook them a little bit. I guess what I'm more interested in is what they have to say about what comes next and whether we can use that as any sort of steer in terms of the Fed, because obviously the BOC, if they cut 50 today, they get down to 3.25%. You'd argue that they're getting very, very close to their own neutral rate. So do they then indicate that actually, they're relatively comfortable with the policy stance and imply that they are going to take a much, much slower pace going forwards, potentially even skipping one or two meetings early next year? And does that in turn provide something of a blueprint even for Powell and co to follow down south in Washington, D.C.? I think that might be the most interesting aspect. But from a trading point of view, dollar CAD is really knocking on the door of this 142 figure. So if we were to get a dovish surprise from Tiff Macklin later on, then we could knock through that pretty quickly.
I think was it the Looney's been at 4-year lows? Is it? Am I right in that?
It is indeed. Yeah,
fair enough. Okay, well, so really it's about messaging from the Bank of Canada. By the way, there is obviously the press conference that follows. Is it an hour later, hour and a bit later? From Bank of Canada. All the terms are on the website in our previews there. Right, I want to turn then to the ECB, which will deliver its rate announcement tomorrow on Thursday at 1:15 GMT. And this is a note from SocGen. They look, the consensus is for a 25 basis point cut, which will take us down to 3% versus 3.25%. SocGen said that after another round of intensive signalling by the ECB speakers, even beyond the near term, another rate cut this week is all but certain. There may be some discussion on whether a 50 basis point cut is warranted, but we don't see the data as sufficiently alarming and instead expect steady 25 basis point cuts until April to a rate close to neutral. We changed our call after soft November survey data signalled that domestic policy uncertainty might be weighing more on confidence than the outcome of the US election, posing a real risk to domestic demand-led growth. So little bits and pieces to unpack there from the ECB. This 50 basis point it was more than just a murmuring a couple of weeks ago, has dissipated a touch. Do you think there is any upside risk to them going larger than expected? All right, Mike, again, sorry.
Personally, I really don't like this. I'm agreeing with sell-side banks far too much here. But I think SocGen have probably hit the nail on the head, to be honest with you. As you say, there was a lot of talk about the potential for the ECB to go 50. I think the fact that we haven't really had any policymakers strongly leaning into that view. I mean, even some of the ECB's doves have been saying we're going to go 25 basis points in December, or as all but pre-committing to that. I think the interesting thing will be probably the sources stories that we get after the decision, and the extent to which there were members on the committee who thought either go 50 now, or who discussed, do we signal that we go 50 in January, what words to that effect. I think that's really the interesting thing to watch. But of all the G10 central banks, outside of the SNB, who obviously are tomorrow as well, I think the risks for the ECB are probably the most dovish of all in G10, just because demand is collapsing in the Eurozone. As we said, inflation is at risk of undershooting the target. And also you've got obviously the political shambles in France and in Germany, and of course the threat of tariffs looming over them as well.
Are you more, this political situation that we've got in both, look, people come and go, this is politics, it's very fast moving, but is it a real worry that you've got the two largest economies in the Eurozone in so much turmoil at the moment from a political perspective, and it takes their eye off growth measures and the ability to generate investment?
I think it's a huge concern. As you say, the two largest economies in the Eurozone are politically rudderless, and potentially France. We know there is a degree of certainty around Germany. There's going to be elections next February. The question is what comes out of those elections. It's likely another coalition to sort of keep the AfD out of power. I think the France one is the bigger concern, because particularly yesterday we heard Macron saying no elections until 2027. I mean, how on earth are you going to find a prime minister to lead parliament and lead a government for the next 2.5 years? It seems like a near impossibility. So I think that's the bigger concern. But you've got no defined political leadership at a time when we're on the verge of what's likely to be another trade war early next year. I think that's a real concern. And you argue, if the ECB go 25 at every meeting, if the ECB go 50, if the ECB come up with some other acronym to try and support Eurozone government bonds, is it actually going to make much difference? They're almost pushing on a string a little bit.
Yeah. Ryan?
Yeah, no, I absolutely agree with that. It's a marked change, isn't it, when you talk about the usual north-south divide. If you're a northern state, the France's, Germany's, you're probably going to be pushing more for a 50 cut than if you're Spain or Greece or some of the others who are doing reasonably well. I think this meeting, and Michael spoke about the sources piece that we might get after. I think that's going to be important, because I think this meeting is going to be a bigger bum fight for those calls between the doves and the hawks at this meeting. And as you said, it's what they're going to signal for next year. So the forecasts that we get tomorrow are going to be really important as to what they see from CPI and growth. But yeah, my view going into 2025 is that I think the ECB are going to be chasing the economy lower. So they will continue cutting, and they're going to probably end up chasing inflation below their target afterwards as well. They talk about declaring victory. They might get to neutral, and then it'll probably keep going. So if there's a central bank at risk of cutting further than they would like, then my money's on the ECB.
Yeah,
can I just a word on the ECB's forecasts, if I may? I agree they're going to be interesting, but the way that the ECB and any central bank calculate these things is a little bit strange, because they effectively assume the status quo will continue unless otherwise told. So although we're kind of sat here going, we don't know what's going on in Germany, we don't know what's going on in France, the ECB's forecasts will, quite ridiculously if you want, assume that exactly the same outlook in September will persist in both countries, even though we know clearly that's not going to happen. So I think the forecasts are actually going to be considerably more optimistic than policymakers are. I mean, you look at the September forecast, they were talking about 1.5% growth in 2026. I mean, is there anyone who believes that's going to happen? Absolutely not. But they'll probably write it down once again nonetheless.
That's a really good point. Point.
Unfortunately, the ECB bods, that's what they believe. They're all, they always say it. Yes, it's going to be December forecast that sway my decision. So they like trading on the hopium as well.
Well, it's the same actually for the Fed next week. Those forecasts that they issue in the SEP are not going to have anything in them about what Trump might potentially do, because that's not government policy yet.
Yeah.
No, and you kind of listen. I'm not here to defend central bankers, but to put the other side to it, I kind of get it in terms of they want to be apolitical. They want to come through, be seen as independent. However you want to picture that. So from their perspective, they can't commit or pre-commit to a certain path. I think the messaging could be clearer though in terms of what they do. I've been to ECB meetings, I've been to central bank meetings, I've asked questions to central bankers, and it just is, I find it bizarre you have to wait for a sources story afterwards to get a clearer picture of what they really think.
Yeah.
That's the whole point of a press conference.
I fully agree on that.
Yeah. What's the danger? I don't get it. I think that this is purely my position. There's more danger of misinterpretation if it doesn't come from the horse's mouth, personally. But there we go.
Yeah, and I think just to add finally to that line, you're right, because Lagarde does like to mention, whether the decision was unanimous or majority or whatever. Yeah. And that's why I think we could see that there's a bit of a bum fight going on, because if she tries to talk the decision as being, everyone was in agreement, and then we get a sources piece saying half the ECB were pushing for a 50, then that's gonna question her credibility as well.
Well, it then questions the unity of the committee in the first place, that they were willing to undermine her. Sorry, Mike, you were saying.
Well, no, I was just going to say that there is a very easy way for the ECB to solve this, and it's just to publish a vote like every other central bank does. But they don't like easy solutions, it seems.
No, that's also a good point. Right, we're coming near to the end of our half hour, but I want to quickly touch on the S&B because it is another one of those instrumental sort of decisions, and in the scope of things, I guess you guys both look at the Swiss franc and its relation to other currencies. So just briefly on that, any kind of anything you have input on the S&B tomorrow? There was, I think, also murmurings that we could see a larger, I think 25 basis points is fairly baked in terms of a cut for tomorrow. Tomorrow. Brian? Mike?
Sorry, hit me button, my mute button, sorry. Yeah, I think a 25 is what we're going to get. Switzerland's has been a funny situation. They never saw inflation ramping as high as everyone else. They never got rates up as high as everyone else. But they've been pretty quick to get rates back down again. So, even as for a couple of weeks ago, they've not ruled out going back to negative rates. The monetary policy in Switzerland's always in a bit of a pickle, and whatever they get up to trading both sides of their own currency as and when they see fit. So it's going to be a funny decision. It is obviously the new guy's first meeting. So is he going to be a carbon copy of Jordan, or is he going to set his own stall out?
Interesting, Mike.
Yeah, I think it's going to be an interesting one. What has caught the eye is that the market has sort of hawkishly repriced over the last couple of weeks. At one point, we were up at about a 60% chance that they go 50. I'm just looking now, and the curve's pricing in about a 38% chance that they go 50. So we have seen those bets paired a little bit. I mean, I guess as always, as Ryan alluded to there with the SMB, the question is, what, if anything, do they have to say about the valuation of the franc? And also, how worried are they about getting back to the zero lower bound or even lower? Because from what recent rhetoric would say is actually they're not particularly worried at all. And I think if they put those sentiments across once again, then that could really start to hurt the Swissy. Although anyone looking to play that from the short side, not advice, of course, you do have the Swiss National Bank who are watching things like a proverbial hawk.
And they're trustworthy as well, so you can always rely on what they say.
Oh, no.
You know, they won't change their mind one day to the next. So.
No, they've never done that before, have they?
No.
It's all good. All right, brilliant. Listen, guys, we're at the end of the half hour. I want to thank you very much for your inputs today. It's been very, I think it's been very valuable and insightful. So thank you. For the wider audience, just to note again, then. So today we got inflation readings out of the US, and then obviously we have Bank of Canada later on today, and then tomorrow we got ECB, or the S&B first, then the ECB. A number of emerging market central banks also due to report on interest rates as well this week. So a busy week for central banks. Generally, for those that trade the currencies, have a lot of fun. But just to quickly recap then on what to expect from today's number. The headline CPI expected up 0.3% on the month over month versus 0.2 last time out. Year over year expected to also tick up a tenth to 2.7. For the core reading, we're looking at 0.3% on the month. Again, would leave it in line with previous. 3.3% also unchanged on the month. But again, just looking a little bit sticky there. And obviously, listening to Live Squawk at 1:30 or 8:30 Eastern time. And we'll also go through and give you that super core and the breakdown of some of the core measures there, because I think that's going to be a key to really just trading the number itself, I think, and trading the move today. But yes, thank you again for appearing, guys. And I'd love to have you two on again as a pair, because I think you're like Morgan and Wise. It's
Yeah, which one?
Hello for our North American friends. I'd love to get you on again, and thank you.
Yeah, always a pleasure, mate. Lovely to be here, and nice to see you as well, Michael.
Yeah, thanks for having us, mate. Cheers.
Thank you, guys. Have a good trading day to everyone, and yes, listen back and break down some of the comments that you hear, or to take out a free trial of Live Squawk at livesquawk.com and listen in live in 45 minutes for the number.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.